Welcome to another episode of the Profit with Estate Planning podcast. Here we produce binge-worthy content for the estate planning law firm owners by interviewing marketing experts, high-producing law firm owners, and professionals who work around death, legacy, and family dynamics. I am your host, Heath Rost, and founder of Personable Media. Today, I'm with Rondi Lambeth of Winning the Tax Game and the School of Wealth podcast, who helps business owners cut their taxes by more than 50%, maximizing their profits, minimizing taxes, and mitigating lawsuits. Welcome, Rondi.
It is so good to be alive. Glad to be here.
We're glad you're here too, Rondi.
Yeah.
Now we like
every day I wake up. That's the first thing I do every day. I wake up and I go, God, thank you so much for another day.
Beautiful. Yeah, I see your background. You've got some. You got an American flag and some of your vehicles that you play around with.
Those are all company vehicles, and that's my company airplane there behind me. You can kind of see it there in the hangar. Yeah.
Awesome.
Those are all real.
Right.
Yeah.
No, so we like these interviews to be inspiring to all of our listeners. And I think an easy way for us to get started is just really to introduce you. What's your background? What led to you becoming a wealth coach?
Yeah. I grew up in Southwest Idaho, so about an hour outside of Boise. I grew up really poor. When I say really poor, I lived in a shack that had no running water, had no electricity, and my family got food out of a dumpster. So I rarely went to school. My parents would not let me go to school. My stepdad was a convicted murderer. He was 30 years older than my mother. He was very abusive, bipolar, multiple personalities. And he got out of prison early because they found out he was mentally ill. So he stalked and murdered a guy and got released after 10 years. And so life as a kid was really hard. The beatings were pretty common, and felt like we were starving most of the time. And after one of the beatings, I decided I had enough. I'm the oldest of 12 kids. And so at 15 years old and weighing 90 something pounds, I took the shirt on my back, $20 in food stamps from my mom, and I left. And I hitchhiked almost 700 miles. I ended up in Oregon. And when I was 16, I ended up getting a job with a very, very wealthy man, owned multiple companies, car washes, real estate companies, construction companies. And what he hired me for was to mow the lawn at one of his offices, which happened to be a funeral home. And as luck would have it, or as God ordained it, his funeral director quit a month after he hired me. And he liked me. So at 16 years old, I become a licensed funeral director and embalmer apprentice. And I did that all through high school and then a couple of years after high school. And that's when I started my entrepreneur journey. Wally taught me that how much money you make is not as important as how much money you keep. And it's nobody's responsibility but your own to learn taxes, to learn the tax code and the tax law. And I remember when I was going to high school, I barely went to high school. I never did homework. I'm really talented. I'm able to take a test and pass with a 70%. But there was one class all through high school. I only got A's in two classes. I got A in weights and gym. And number two, I got A's in accounting/economy. And what was interesting about that is Mr. Labhart, who went to high school with my parents and hated my father, did not like me either. And he called me a loser in front of everybody. He said I was white trash. I'd never account to be anything. And I remember he failed me. That's the only class I failed in high school. Everything else I got C's and D's. That class I had an A. And he failed me because he thought I was cheating. And what he didn't realize is that was the only homework that I did. I would go back to the funeral home and I'd ask Wally, who was worth millions and millions of dollars. And Wally would coach me. And so I was answering questions based on coaching I was getting from real life success story. And the teacher failed me because he's like, no teenager, no high schooler should know how to invest in the stock market, how taxes are calculated. You shouldn't know how to balance a checkbook. You shouldn't know what a profit and loss statement is, balance sheet, etc. And that really pissed me off for many, many years, about 20 to be exact. In fact, my airplane, which is sitting behind me, I used to fly to Oregon in the summertime once to twice a month. to go fishing and go hunting. And I would literally fly over this Labhart's house and circle it. And over the radio, which everybody had an airplane in the area would hear it, and anybody using police scanners, little tiny towns, so they all have police scanners. I would literally call out Mr. Labhart and say, "Hey, Mr. Labhart, this is the loser Rondi, the man that you said would never account to be anything. Well, I'm above your house in $1 million plane right now. So who's the loser now?" I did that, Keith, for about 7 years. And then afterwards, I was like, all right, I'm good. I moved on from the hate. I didn't let it hold me down like an acre. I used it as rocket fuel. But what I learned from Wally was being an entrepreneur is the way to go. And college was not my thing. I mean, I barely went to high school. I barely went to grade school. Most of middle school, I never went because my parents wouldn't let me. And in fact, the time I got beat up the worst when I left was because I snuck out and I went to school. I went to 8th grade and I got caught coming home, and Paul was out of town, so I thought I'd get away with it. Well, he got home early and he beat me unconscious. And that was the last time he beat me because I left. So that was kind of my background. And then I left Wally. I decided I wanted to be something bigger than what I could get out of a little 2,000 person town. So I moved to Denver, Colorado. And Wally told me, he's like, you need to get a good, safe, secure job that gives you free time to expand on your entrepreneur. I was like, well, I'll be a fireman. So I applied for the fire academy, and I'm very physical, and I can take tests really well. And I had military background experience. So I become a fireman, Littleton, Colorado, started working 8 days a month as a firefighter. You know, you get 150, sometimes $200,000 a year if you're a paramedic at 8 days a month, 10 days a month. And then that let me spend the other 20 days learning business. And I got a book by Robert Kiyosaki, and that just changed everything. And I've been running hard ever since. I own credit repair company, debt settlement company, a law firm. And by the way, I'm not an attorney. And I know the attorneys are listening like, wait a minute. If you're not an attorney, Rondi, you can't own a law firm. Well, yes, you can. If you can prove to the bar that you are an expert in your field. Well, I'm an expert in consumer law. I've worked on hundreds of cases as an expert witness. I've helped hundreds of thousands of people restore their credit, minimize their debt, reduce their taxes. And so I originally applied in Arizona and Utah, got approved to own a law firm there, but then they started dragging their feet. Went to Washington, D.C. In 30 days, they approved me. And so I run a law firm out of Washington, D.C. that I am an owner of, that an attorney works for me, does the legal work. I have paralegals that work for him, and we share the profits. So fast forward now, I'm 55 years old, and I've helped people now save well over $100 million in income tax and bad debt, etc. So that's how I got started.
Amazing. Thank you for sharing that story, Rondi. I hadn't heard that part about your teacher. What was his name?
Mr. Labhart, Chris Labhart.
Chris Labhart. Well, he definitely
you know what's
created
funny?
something in you.
My last thing I did was I had a guy reach out to me. I was out there hunting, and I was sitting at the bar, you know, like what good hunters do after a good day of hunting. And this guy goes, yeah, I'm running. And I'm like, oh, he's running for county commissioner. I said, who are you running against? He's like, Labhart. I'm like, you tell me, you give me a dollar amount and I will give it to you right now. I want you to win. And I literally, he's like, well, what? I don't need the money. I need signs. I'm like, well, how many signs do you need? He's like, well, there's 2,000 people in town. I'm like, done. So I literally paid for 2,000 signs, shipped them to him. And of course he won. And that was my last FU to Mr. Labhart.
Well, in light of that, why do you think that schools teach people how to earn money and not how to keep it?
Because that's the system, Heath. That's the system. They teach us how to earn money because they want you to earn money. The last thing I want to do is earn money. And what I tell my clients, the first thing we're going to do after we get your corporate structure set up and protect your assets, the next thing we're going to do is we're going to eliminate all earned income. You're not going to earn anything for the rest of your life. You're going to receive it in dividends, in capital gains, and in passive income. No more earned income, because earned income is who people who get earned income are the ones that pay the highest percentage in taxes. The other thing the government figured out a long time ago, and this was after the Great Depression, John D. Rockefeller, J.P. Morgan, and some other of those billionaire types decided they actually went to Russia and interviewed. Back then, it was actually Russia back then. That was before the Soviet Union. And they said, how do you get people to, go to school and work in a factory all day? And they're like, oh, it's simple. We start when they're really little. Because Americans, prior to really World War I, we were a bunch of entrepreneurs and we had family-run businesses. And with the Industrial Revolution, they needed employees. And so they had to figure that out really fast. And what they figured is if we start teaching them and brainwashing them, programming them at a young age, go to school, get good grades, go to college so you can get a good, safe, secure job. And then you can retire and live your life in Florida with your waistband up into your armpits with your plastic Crocs and walk around and complain about the neighbors stepping on your grass. That life is not for me. Now, it might be for some people, and that's fine. But the reason that we're not taught anything about finances, investing, credit, or taxes in high school or college or law school is because they don't want us to really understand the tax code. They want us numb and dumb and paying more in taxes than legally required to pay. In fact, Forbes did a study, 10-year study. Tens of thousands of business owners sent their tax returns to Forbes and participated. And here's what they found at the end of 10 years, Heath. 93%, that's not over 9 out of 10 business owners, 93% paid more in taxes than legally required to pay. 93%. And I guarantee you, if I looked at your taxes right now, Heath, I promise you, you are paying more in taxes than legally required to pay. Now, I love paying taxes. I think I'm one of the few people out there. I love it. This year, I actually did a social media post because I was so proud that I paid taxes this year. I generated millions of dollars and I paid $71 in self-employment tax. No state, no federal, no unemployment insurance, no workman's comp. Millions of dollars of revenue, not income, because I don't earn income, but I get dividends, I get capital gains, I get distributions. So I got all of that, paid $71. So that's the reason they don't want you to know anything in school, is because by you not knowing, it fuels the system and allows for the fraud, waste, and abuse. Because if the politicians didn't have hundreds of billions of dollars to fraudulently steal or waste or abuse, if we as citizens would wisen up, learn the tax code like I'm teaching people, and we started paying what was legally required to pay versus tipping the IRS, there'd be no money for them to steal or waste. They'd actually have to balance the budget. So it's all part of the system.
So you said something that really struck me really well, is that they don't want us to know the tax code.
Yeah.
And you know the tax code. So
very well. Yeah.
Very well, right? So a lot of these estate planning attorneys, there's some that are over, doing over 7 figures a year. Most of them are between 200,000 to, $1 million a year. As these law firm owners are growing their law firms, at what income level do you think that someone should stop thinking like, a solopreneur and start acting more like an asset protector?
Well, the answer to that question is it depends. I learned that term working at Doan Law, which is the largest bankruptcy firm in California. I was their credit expert witness. And they told me that very easy. It depends. So Heath, what it depends on is, do they want to protect their assets? Do they want to reduce their taxes? Because if they don't, they can just be like the 93% of other business owners that pay more in taxes. So if they do want to save on taxes and eliminate the likelihood of being sued, or at least eliminate the risk of ever having money taken from them or assets taken, then they didn't need to do it before they even go to law school. They should figure this out. So If they're already out of law school, my answer to your question is immediately. There's no such thing. Here's the thing. This is what CPAs do. They're like, well, until you make $100,000, you should just be a sole proprietor. Nonsense. Well, once you get over 100,000, you should become an S corp. Complete garbage. The reason that a CPA wants you to become an S corp, if you really want to know why, is as a sole proprietor, it's one tax return. It's a personal tax return. It's $1,000, $500 to $1,000. When you elect, you fill out IRS form 2553 and you become an S corporation. Now you're an S corporation, big boy pants now. Not only do you pay $1,000 for your personal return, you pay $1,500 to $2,500 for your S corp return. You pay for bookkeeping services with the CPA. You pay for quarterly taxes with the CPA. You have to do a reasonable salary now, and you have other expenses. So it enables the CPA to double, if not triple, their revenue off of one client. And it's not any more work for them. So that's why they push this S corp thing so much. Who else encourages them to do it? The IRS encourages them. If S corps were so great, then why isn't Amazon an S corp? Why isn't YouTube an S corp? Why isn't Facebook an S corp? If every single publicly traded company is a C corporation, every single billionaire runs their companies as a C corporation, the wealthy know that the benefits are at the C corp level, at corporate level, not at S corp level down in small business land. So back to your question, when should they do it? The moment they decide they want to protect their cash, pay their silent business partner, the IRS, less, and protect their assets.
Perfect. So right away, we need to do it now, right?
You do right now. Don't do it tomorrow. Right now.
Before we get back to the episode, I want to mention something quickly. If you own an estate planning law firm and you want more qualified clients coming in every month without relying on constant referrals or paid ads, that is exactly what I help attorneys do. I work with estate planning law firms that want consistent leads, better cases, and a practice that grows predictably year after year. If that's something you want, go to predictableestateplanner.com and book a strategy call with me. Now, let's get back to the episode. I know a little bit about, your strategy, your approach to doing this. And I know that our listeners, they're hooked, they're ready to all right, so what is this guy doing? How is he doing it? I know that there's some business restructuring, and I don't know, how much detail you don't have to go into a ton of detail on it. I know you could talk for hours on this topic, but could you give our listeners just a preview of what would be involved from a business structuring and maybe even, a bank account structuring process for that?
Yeah, let's go with your attorney making $200,000 and your attorney making $1 million. We'll use those as those two examples in profit, not in gross, but in actual net profit. After you pay all of your employees, all of your court fees, that's your net profit, $200,000 or $1 million. At $200,000, living in California or Colorado or New Jersey or Utah or any of the other states that have more than 0% tax brackets, which most of the states are around 5%, some are 10, some are 13. But someone at $200,000 of net profit is going to pay right around $50,000 in income taxes. Someone at $1 million profit is going to pay right around $400,000 in income taxes. So when should you start planning? Well, as soon as you start making money, because at $200,000, I can make that zero. At $300,000, I can make it zero. No income tax, none. At $1 million, I can take it from $400,000 to about $150,000. That's substantial savings. Imagine what kind of a advantage that gives someone, Heath. Two attorneys start out day one.
It's a house.
It's a house. Every year, it's a house. It's a rental house every year. And imagine, Attorney A pays us $50,000 in taxes. Attorney B pays nothing in taxes. That's $50,000 more. He just increased his profit margin by 25% and didn't do anything different other than the corporate structure change. So what change am I talking about? Well, the problem with LLCs and S corps and all of the talking heads on the internet Is they're like, oh, you want to save money on taxes? Set up an LLC. Well, guess what? LLCs provide you with zero income tax reduction, not one penny. S corporations, oh, you're making all this money, become an S corp. Guess what that saves you in income taxes? Nothing, not one penny. So LLCs and S corps save you nothing in income taxes. Now, what the S corp saves you in potentially is self-employment taxes, but only if you're making hundreds of thousands of dollars a year. If you're making 200 grand as an attorney, an S corp is not going to save you any money in self-employment taxes because you have to take a reasonable salary. So let me ask you, Heath, what attorney do you know that runs a big, large firm that would say a $20,000 a year salary is reasonable? None of them.
None of them.
Now, they can cheat, and there's lots of tax cheats out there, including CPAs that get them to cheat. And eventually they'll get caught because it's the number one reason that people would have an S corp get audited is their salary's not reasonable. It's on the first page of your tax return. Very first page. Revenue, wages. If there's no wages, it's not reasonable, you get audited. So what should you do? Well, one, do what the big companies do. And what do? They have C corps. So what I do is we take your law firm. We'll call it an operating company. We're going to sell the ownership of that operating company to a holding company. So we set up a Wyoming LLC as the holding company. The holding company owns the law firm. You're also an owner in the law firm, and you're the manager of the law firm, and you're in 100% control because you own the holding company and you're the manager of the opco. Okay. So now what happens is instead of that profit flowing, because LLCs, limited liability partnerships, like what you'd set up for your law firm or a legal corporation, whatever you set it up, S corp, those are pass-throughs. So the income passes through to you via K1, you pay taxes. The losses pass through to you, you take it off of your income tax. And so do the lawsuits. So if your LLC or S corp gets sued, guess what? It flows through to you personally as well. I guarantee you, if someone ever sued you, and these attorneys know this, they don't just name the LLC, they name the LLC and all of the members and all of the managers and all the owners. So what we want to do is we want to separate ownership from control. So you control the op company, the law firm, but you don't own it. The business hub in Wyoming owns it. Why Wyoming? It's the only state that does all three of these things. Wyoming has no reporting. So if you go to the Secretary of State and you look up Heath Ross Law Firm, guess what? It's going to have my name on it as organizer, not Heath's name. It'll never be there. And if you want to get it, you have to get a federal warrant and go to Wyoming and get the judge in Wyoming to release it. Good luck with that. Number two, there is no income tax. None. Zero. A lot of people say, well, yeah, but Nevada's better. No, Nevada has income tax. If you make $5 million or more, there's now income tax for business owners. Yeah, that's right. $5 million of revenue, you get taxed now. Now, if you're small enough, great, then do Nevada, but it costs a lot more to incorporate Nevada. And number three, no charging order. The attorneys are going to love this. No charging order, which means for non-attorneys listening, if your LLC, your Wyoming LLC gets sued and you lose, and the defendant or the plaintiff rather gets a judgment against you, the defendant, the LLC, if it's a charging order state, the court can take charge of your company. They can drain the bank accounts. They can sell the assets. They can interfere with the contracts. They can sell the company. They can take charge. But in Wyoming, if you get sued and you lose, the plaintiff gets nothing but the ability to file a lien against you. You never have to pay them. They could get $1 billion judgment against you, and they're never going to collect. All they can do is sit there with their hand out and say, Heath, please pay us, please. And you're like, no, I'm not going to pay you. Well, Heath, we're going to take your distributions. That's great because guess what? You don't do anymore. You don't take distributions. Instead, what we do was with that operating company, we do a contract between the business hub, the holding company, and the operating company. And that contract, we set it up before you're sued. And it might be $100,000 a month goes to the holding company, $200,000 a month, whatever your profit is, whatever we want to set it up for you. So now, as soon as your op company makes 100 grand in profit, it goes to the holding company. If you get sued after that contract's set in place and after you've been paying those payments, they can't interfere with the contract. Therefore, they never get paid. So first step is to set up a holding company that owns your operating company. Second step is we're going to set up a C Corp in Wyoming. Same 3 reasons as before. The C Corp owns the holding company. The reason the C Corp owns the holding company is LLCs are pass-through entities when it comes to taxes. So if the C Corp pays, or if the C Corp owns the holding company, the C Corp is responsible for the taxes. And the taxes on a C Corp are 1/3 of what the taxes are as an individual in California. So right there, you're saving 70% in taxes by just having a C Corp own the holding company. Mm-hmm. And then the next step was we set up a single member LLC taxed as an S Corp in the state where you live. So if you live in California or Colorado or New York or New Jersey or Illinois, and you don't want to pay personal income tax in those states, then you need to stop earning money in those states. Well, how do you do that? You have all the profit go to your holding company. The holding company has a contract with your S corporation in one of those high tax states. And you take just enough money out of the holding company to your S corp, just enough to live, not enough for investments, not enough to go on crazy trips, not enough to go buy real estate, just enough to survive. And now what we do is we leave the money in the holding company, and the holding company buys you your next Mercedes. The holding company buys the real estate. The holding company invests in the stock market. The holding company buys other companies. And now you can generate millions and millions of dollars through this structure, pull out about 300 grand out of your holding company and pay no income taxes. Now, if you need more than $300,000 to live, and some people have big lives, they need more than that, then what we do is what the rich do, and that is they borrow it. There are banks out there that will loan you money, secure it with shares to your C Corp or certificates to your LLC, or you can simply just borrow it from your holding company. It's got all the cash. Instead of pulling it out and paying 60% tax, let's just borrow it. If I need 100 grand, I borrow it from my holding company. I don't pull it out and pay taxes on it. I borrow it. Now, you might be saying, well, there's interest. Yes, there is. And yes, the holding company is going to have to pay income tax on the interest. And on $100,000 that you pull out, it's going to cost your structure $1,000 in taxes. So would you rather pay $60,000 in taxes? Even at the low end, you're going to pay $20,000. Or would you rather pay $1,000? And so that's the structure. And this is what every single major company does. And I'll prove it to you. And I'm going to add, they say never ask questions you don't know the answers to. I know the answers, but I don't know what you're going to say. Mm-hmm. So I'm going to put you on the spot, Heath. Is that okay? Absolutely. I know it's your show, but who owns YouTube?
Google.
Google. That's right. So YouTube is the operating company. Let's just pretend YouTube is your law firm. Now the holding company is Google. Who owns Google?
ABC.
ABC. That's right. The alphabet company. ABC is the C Corp that owns the holding company. The holding company owns YouTube, uh, Fitbit, and Nest, and a whole bunch of other companies.
Okay.
Now, how do you get paid if you were the owner in this? How would you get paid? A contract to your S Corp.
Right.
So the money comes into YouTube, the profit goes up to Google. Google throws out the contract over to the side for your 300 grand, and the rest goes to the C Corp to pay the taxes, and Google holds all the cash. How about Facebook, Instagram? How about Amazon? Amazon owns Whole Foods.
Okay. So essentially what you're doing here is you're helping the little guy to do what these enormous corporations are doing.
That's right. We are helping the small to medium-sized business operate like a major corporation. Like every single publicly traded company, every media company, every TV company, every movie company, all the rock stars, all the actors. The reason that actors never complain about taxes, have you ever wondered, like Tom Cruise gets paid $25 million a movie. Why is he not complaining about taxes? Well, I'll explain it to you. Because he's not paying it. He pays income taxes, but he's paying it at a corporate level. See, if you ever watch movie credits, you ever notice, like, look at our names on the screen right now. You see how our names are upper and lowercase?
Right.
That's you as a human. That's Heath Ross as a human being. If you look at your driver's license, it's all caps. If you look at your birth certificate, it's all caps. If you look at your social security card, it's all caps. That's the corporate Heath Ross. That's the corporate entity. If you look at the movies, all of the credits are in caps. That's their corporation. So they're celebrating Tom Cruise, but they're paying Tom Cruise Incorporated. They're not paying Tom Cruise, the human being. And so when you start thinking the way that the billionaires think, and you start doing what the billionaires do, you get to experience the tax benefits and the asset protection that the billionaires get.
Amazing. So
hopefully I haven't completely overwhelmed everybody. Usually when I go into the structure, I draw it out because it can get confusing. But, think about it. Amazon owns Whole Foods. Whole Foods owns a whole bunch of the companies that sell food. Whole Foods goes, and if you have a food company and you're just crushing it, they go buy you. And now they get all the profits. That's how they work.
Right. So I speaking for, some of the, attorneys and law firms that we work with, I know that, some are less than 10, but some are even less than 5 years out from wanting to exit, right? Sure. We always talk about, thinking with the end in mind. That's kind of the premise of estate planning to begin with. So, I can see some law firm owners thinking, oh, I'm too far along. I'm 2 years and I'm going to, I don't need to change everything now. I'm 2 years out. Why should I do this? And also, what happens when I die, right? If I have this all set up in this way, what happens when I die? Or if I go to sell it, what's that going to look like?
Well, here's the question. If a client comes to me or someone comes to me and says, hey, I'm 2 to 5 years away from exiting my business and selling it, what should I do? And so my question to them is, well, do you want to pay income taxes on the sale of your property? Do you want to pay capital gains tax? Because if the answer is no, then we need to change your structure now. And here's why. C corporations are exempt. They get a $15 million per shareholder exemption on capital gains. S corps don't get that. LLCs don't get that. Limited liability partnerships don't get that. Professional LLCs don't get that. Only C corps. So if you have a law firm and you're going to sell it for, say, $5 million, you're going to pay $1.5 million in capital gains tax. Where if you were one of my clients, you would pay zero. You could sell that. Let's say you had 5 shareholders. You could sell that company for $75 million and pay zero income taxes. I just helped a client sell their company for $200 million and they paid zero in capital gains tax. So when should you be thinking about it? Like right now. Now, there's things that you have to do to make this happen. And it only works if it is a C corporation. And there's a lot of things that apply to it. You got to own it for so many years. You got to have basis in it, et cetera. But that's just paperwork. So if you really think about selling your company, you should seriously consider and do some research on the ability of selling your C corp without paying capital gains tax.
You mentioned you have to own it for a couple of years. So for law firm owners that are trying to sell it right now and they're thinking 2-3 years out, like do you have an approximate number on that? Is it like 2 years?
Yeah, it's I think you get a 25%. If you do it today and you wait 2 years, you get 25% of the $15 million. And then at 3 years, you get 50%. At 4 years, you get 75%. And then at 5 years, you get the full $15 million. So listen, if you got someone who's making $5 million a year, well, and you sell it in 2 years, 50% of $15 million is $7.5 million. Like, why not do it? And in fact, there is a way. I spent 3 days with Robert Kiyosaki's CPA. His name's Tom Wheelwright. He's one of the best CPAs in America, if not the world. And I spent 3.5 days doing advanced tax strategies with him. I paid a small fortune to be there. And he shared something with me with this program. You don't have to convert your law firm into a C corp. You simply sell all of the assets of your LLC to a C corp. And you sell all of the intellectual property to the C corp. And now, when you go to sell your law firm, you actually sell the C corp and they get the law firm included in the purchase of the C corp. This is how you do it without paying double taxation all of those years. Is you plan in advance. That I know it's kind of, everybody's heard it. I don't know about everybody, but when's the best time to plant a tree? 20 years ago. When's the next best time? Right now. So when's the best time to get started with setting up your structure the right way, the way that billionaires in corporate America does it? Like when you first start. The next best time is right now, because nobody is there to save you. Nobody cares about your money as much as you should. The CPAs don't care. Here's the thing with CPA, and I get this every single day. And I used to like try to tiptoe around this. I was thinking, because I'd have all the hate online from CPAs because I'm exposing their laziness and their unprofessionalism, and they don't like it. And so I was like, oh, maybe I should like back off a little bit because maybe I'll get referrals from these lazy people. Well, I don't get any referrals from CPAs. So now I'm just going to let them have it. A CPA is like a referee. They know the rules. They're there to make sure you follow the rules. They're there to make sure that you file on time. You got the right paperwork. They're great at looking at your books. In fact, a CPA is a certified public accountant. 90%, according to the IRS, 90% of CPAs know nothing about filing taxes or tax strategy. The good CPAs are not tax filers. The good CPAs work for billion-dollar companies. The good CPAs work for billionaires and banks. The shitty, lazy CPAs, they file people's taxes. And the really bad ones work for H&R Block and Liberty. And the really, really bad students, the D students, work for the IRS. So let me finish with this thought. Do you like football?
Yeah.
We got the World Cup going on right now. Have you ever seen a player? Imagine Tom Brady, one of the greatest quarterbacks of all times. Imagine Tom Brady. It's the last few seconds of a Super Bowl. They're on like the 3-yard line. They're about to beat the opponent. But he's not sure what play to call. He's not sure how to get the ball over the end zone. So he calls a timeout. The greatest quarterback of all times. Does he run over to the the referee, AKA the CPA? Does he run to the referee and say, ref, I know you know all the rules, and you've been watching the game, and you've been watching the opponent, you've been watching us. What play should I run? Should I kick it or should I obviously he doesn't kick it, but should I run it in, quarterback sneak? Should I pass it? What should I do? That's ridiculous. He would never go to the referee. He goes to the coach. The coach wants to win. The referee doesn't care who wins. They just want to make sure you follow the rules. So when you as a business owner, when you go to your CPA and you ask them, how do I beat the IRS? Well, there's not a lot you can do. In fact, look at this freaking book. This is one of the most popular CPAs in America, Greg Crabtree. 200-page book. It's a great book on accounting, by the way, but I got to highlight it here. It says here on page 7, the federal tax bracket's 35%. So at least you get to keep 65% on every dollar before state taxes. And that's a lot better than nothing. This is a CPA saying at least you get to keep 65%, 35%. You should be happy, Keith, with your porridge and your burlap for your clothing. You should be happy I give you a roof over your head, even though it has no electricity, no water. You should be happy I'm not beating you and throwing you in prison. That's ridiculous. And yet that's what the majority CPAs do. You and I know someone that's one of those people. Like, oh, well, you can't write off your kids and you can't write off your car. I saw one this morning. Now I'm getting pissed off. I saw a post this morning on Facebook. It was a picture of his Ferrari. He had it all wrapped. And he said, I just found out from my CPA I can't write off my Ferrari. Does anybody know how to write off a Ferrari? And then he had all the hate from all the haters, like, you shouldn't drive a Ferrari. You know how many people that would have fed? You know how many people buying a Ferrari feeds? A lot. Mm-hmm. There are a lot of people involved. And so I replied with him and said, you need to fire your CPA because you're asking the referee for tax advice. That's stupid. You need to get a tax advisor and ask the coach, how do you beat the opponent? And because you can write off a Ferrari. In fact, Keith, you can write off anything. Anything. You know, if you went out and there was a business purpose for you to buy cocaine, say you're Jordan Belfort, which is one of my clients, you're Jordan Belfort and you're making $50 million a year on the New York as a stockbroker and you're buying cocaine, guess what? It's tax deductible. Now, it's not legal, but why did Al Capone go to prison? Because he paid taxes on his theft, on his prostitution, and on his drug dealing. If Al Capone would have paid taxes on his drug dealing, then he would have never gone to prison for tax evasion.
Hey, real quick before we finish today's episode, if you've been listening to this podcast for a while, you already know that most estate planning attorneys don't have an audience problem, they have a marketing problem. They start with a new website and agency, then things slow down, they try ads, and the cycle repeats. What I do is I help estate planning law firm owners build predictable lead generation using a proven conversion system that keeps working month after month. If you want help building that kind of marketing for your firm, go to predictableestateplanner.com and book a strategy call with me. Now, let's finish the episode. No, man, that's great. Everybody's loving hearing that. I guess, one more kind of follow-up question that I have is, some of these strategies that you're implementing require us to spend a certain amount on other assets, car, boat, house. Can you give us an idea of what kind of responsibilities that we're going to have when we start executing a strategy, if we were to execute this strategy?
Yeah, generally when your CPA gives you a strategy, it does require you to spend money. Their solution at the end of the year is go buy a new car, go spend $100,000 or $150,000 on a Range Rover. That's their solution. My solution, 3 of my solutions don't require you to spend, in quotes, air quotes, spend money with anybody else. Now, yes, you have to transfer the money. Yes, you have to move it from your bank account to the other bank account. But guess who still has control of it? You do. See, we separate ownership from control. We separate the ownership and we put it into another bank account that you control. Let me explain. In the tax code, it's tax code 262A or 262. Now, what that tax code is it says anything that's ordinary and reasonable, anything that's ordinary, necessary, and reasonable in a pursuit of making money is tax deductible. Earlier in the tax code, it says nothing is tax deductible and everything is income unless we say it's not. So everything is income unless we say it's not, and nothing is tax deductible unless we say it is. That's in the beginning of the tax code. Fast forward, I said 262, I meant 162. Fast forward to section 162 of the code. It says if it's ordinary necessary in the pursuit of making money, you can deduct it. Full stop, period. Fast forward a little bit to 1960s. So this was our tax code we have now was really developed after World War II. So they've been tinkering with it for the last 50, now 70 years. But 1960s, there was a congressman or a senator rather. He was living in Augusta, Georgia. And every year, April of every year, hundreds of thousands of people go to Augusta, Georgia to play golf or watch players play golf. And there's nowhere for these players to sleep. So what the rich folks do, including the senator, is he rented his house to one of the players, and they rent their house for a lot of money. In fact, it was so much money, he owed the IRS 6 figures for 2 weeks. So that tells me he rented that house for probably around $300,000, around 20 grand a day, which is very reasonable. If you don't believe me, go on Airbnb and you'll find houses for $20,000 a day. There's one in Aspen, Colorado right now. It's $55,000 per day to rent this house. And there's lots of them like that. So this senator rents his house for a few $100,000, gets a tax bill, 6 figures, and said, this is bullshit. I'm a senator. I shouldn't have to pay taxes. I'm the one that creates the tax law because it's Congress that creates the tax law. It's the IRS that enforces tax law. So he gets together with all of his buddies, aka Congress, and goes, how about we create a new tax law that says we can rent our primary residences to anyone for any amount, and we don't have to report it as income, as long as we don't do it more than 2 weeks of every year. So Congress thought about it. They're like, wait a minute. That means, could I rent it to my business? And they're like, well, yeah, let's put that in there, that we can rent it to anyone for any amount. And we don't have to report it. Therefore, we don't have to readjust the budget every year. It's the only place in the 75,000 pages of the tax code, by the way, that you don't have to report income. The only place. And let's start renting our homes to our own businesses so we can pull millions of dollars out of our company and not pay income tax. So they passed IRC, Internal Revenue Code 280A. And what people don't realize, this was passed and signed into law in 1970. That was 56 years ago. So Heath, has your CPA ever asked you if you're renting your house to your corporation or your LLC?
No, never.
Nope. Why? Why doesn't the referee want to help you win? 1, because they're lazy. 2, they're ignorant, as in they don't know the law. They're very smart people. Listen, CPAs are important when it comes to keeping track of your basis and your countings and your profit and loss and your account receivables and your invoicing. They're great at bean counting. That's their job. They're the referee. They're required, but you can't win a game with just the referee. Now, occasionally you win the game because there's a bad call, but it's not the referee that did the mistake. It was just the call, right? So they come up with the Augusta rule. That's the nickname, but it's tax code. People call it loopholes all the time. Anybody who calls stuff a loophole, they just don't know any better. There are such things as loopholes, but Augusta rule is not a loophole. So when you said you have to put money, you have to spend money, check this out. Instead of you doing a draw or the attorney, let's say the attorney's making $200,000 a year profit. Instead of taking that out as a salary, which is taxable at the highest rates, or a draw, which is taxable at up to 37%, how about we take 100 grand of it as rental income? Yeah, rental income. $8,000 per day for 14 days is $120,000. Tax free. and you don't put it on your tax return. In fact, this is why the CPAs don't tell you to do this, because they've been trained in this little tiny box. They're stuck in this box. They're like, well, you made the money, you got to put it on your tax return. No, the tax code says do not report it. If you report it, it's a $5,000 fine. So if you go to your CPA and you say, hey, I'm going to do the Augusta rule, they're like, hey, report it then on your Schedule E. If you do that, you could be fined $5,000. Who's going to pay that? You are. CPA is not going to pay it. And so they just tell you, they just don't say anything about it. And then if you say, oh, I'm going to do it, they'll be like, oh, you're going to get audited. You're going to get audited. How are you going to get audited if you don't put it on your credit, on your tax return? How's the IRS even going to know? Because it says do not report it. It clearly says in the code, do not report this income. So now instead of taking 200,000 out as a salary or 200,000 out as a distribution, you take 120, 150, 100, 200,000 out via Augusta rule, and you pay no taxes. So this is what I mean by income shifting, recategorizing the income. All the wealthy people do it. Here's the next thing. I bet you some of your attorneys have kids.
Yeah.
There's a special tax code, and this one is, I think it's 2161. And maybe it's 3121, or maybe it's both. 2631, 3121, something like that. But what it says is if you're a small business owner, they want you to be successful. And they know that sometimes it's hard to find employees. And so the code, the law says that if your parents own the business, they can employ their children 17 or younger, and they don't have to pay payroll taxes. No self-employment, no Social Security, no workman's comp, no state, no unemployment. They just write them a check. No tax. And if it's less than $16,000 per year as of 2026, kid doesn't have to file a tax return. So if you got 3 kids, you can write a check to your kids, $16,000 each. They can put it into their bank account, which is really your bank account because kids can't have bank accounts by themselves. So it's mom's bank account with the kid's name on it. You write the check to the kid, you put it in the kid's bank account. Mom has the debit card. Mom pays for clothing and food and everything else with that. Or you invest it. If you got extra money, you invest it for the kid. And now the kid's worth millions of dollars by the time they're 25, 30 years old, all through not paying income taxes. And then when you go to college, it goes to $35,000. So instead of you paying, I got a client right now, he's paying for 3 kids in college. And I said, instead of paying 3 kids in college, why don't you pay your kids $35,000 each, and then you pay for the college out of the kid's bank account? And he's like, you can do that? I'm like, absolutely, you can do that. Now, why does the government want us to do that? Because they want business owners' kids to go to college. Now, why would the government want an entrepreneur's kid to go to college? Well, what does the government want? They want employees that are numb and dumb and pay taxes. They've lived 18 years with their dad and their mom as entrepreneurs, and they've been taught you need to start a business. And they know if they can send them to some liberal school, they'll get brainwashed into socialism, and now they got a taxpayer. And so they reward the parent by allowing the parent to pay the child $35,000, and they don't have to pay any income tax on that. Now, that's my conspiracy theory. I don't know if it's true or not. But what I've found since COVID is most of the conspiracy theories are coming true. So you can do Augusta rule, so you can pull out hundreds and hundreds, up to millions of dollars, because there's no limit. Mm-hmm. So, and you don't even have to own the house. Right. It doesn't even have to be a house. It can be an apartment or a condo. It can be a boat. It could be a van down by the river. As long as you're a primary residence, there's no limit to how much you can do it. But if you rent it to your business, then it has to be reasonable.
Sure.
So what makes it reasonable? Well, a 3-bedroom house for 3 shareholders would be the same as a hotel room for 3 people. And as you and I both know, when you do seminars, meetings at a hotel, you got to pay for the AV equipment, you got to pay for an extra room, and it's thousands and thousands of dollars potentially. So the IRS is like, hey, if you want to do it at your house, you can do it at your house. As long as you have the agenda and you have keep track of who was there and what you talked about, and you actually move the money from your business account to your personal account and you code it right, you don't report it as income. So those are just two ways you can pull money out of your company and not really spend it. The third way, and I'm going to end with this one, you set up a foundation. The foundation allows you to put 60% of your AGI, adjusted gross income, 60%. So you make 200 grand, you can put $120,000 in your foundation, take the other $80,000 out through Augusta rule. Now you paid no taxes. Then you're thinking, well, foundation, I got to give away that 120,000. You got to give away at least 5% of it. I think you should be giving away 10% of your money. I really do. I tithe 10%. I think everybody should. So 5% is reasonable. Now, what do you do with the remaining money? You invest it. You buy real estate with it. You buy stocks with it. You buy silver. You buy gold. You buy other businesses. What you don't do is go buy a car in it and then drive the car. You have that foundation own businesses. Now the foundation's making the money and they don't pay income tax. And then down the road, when you're long gone, and that's all part of your estate plan, your family now has potentially millions of dollars in this foundation, thanks to the IRS code that says you can put 60% of your income into it.
So just to clarify, you don't actually have to buy a house. You could buy stocks. You could buy gold, silver.
You can buy anything you want, as long as
I like that.
You're not benefiting from it. So if you went and bought a house and then you moved into the house, and people do this,
right?
They're tax cheats. They buy a foundation and they're like, oh, I got to live in the foundation, in the house. Come on. The revenue officer is going to look across from you from the table and say, we know what you're doing. It's self-dealing. Come on.
Right.
Now, can you buy a rental property or can you buy stocks? Yeah. And someone else lives in it? Sure. Can you have your family members work inside the foundation? Sure. As long as they're paying taxes on their income, just like any other job. You can't just, run the money, but, look at people do it. Look at the Clinton Foundation, billions of dollars. Where's all that money? Or the Gates Foundation or any of the foundations. I mean, murderer O.J. Simpson had a foundation. And because it wasn't his money, when he got found guilty of murdering those people, not criminally, but civilly, he didn't have to give them any money because it wasn't his. It was in the foundation.
Right. So it was protected.
It was protected, or it is in trust.
Right.
Yep.
I think that last thing that you shared about, a lot of our law firm owners have kids. A lot of them are going into college. And I think a light bulb might have just gone off about, oh my gosh, I could be paying them $35K into their own account, and then I could pay their tuition out of that. That might be the biggest goal that a lot of these attorneys are going to take away here. I know personally, I have questions that I'm going to ask you in follow up to this. And I know our other attorneys are going to have questions too. So, Rondi, how can our listeners get a hold of you? And do you have any upcoming events that you want to announce, that you want to share?
Yeah, they can get in touch with me at rondilambeth.com. That's rondilambeth.com. If you go to Google and type in Rondi, Rondi, you're going to find me. If I'm on every single social media platform at Rondi Lambeth, just make sure it's the verified blue check mark, because there's lots of scammers that pretend to be me and that then they want to sell you crypto, right? And trading programs. That's not. So make sure it's verified, just at Rondi Lambeth. And then I do events all the time. Once a month, I do an event. In fact, I'm doing one next week on the 24th. I'm not sure when this is going to air, but you can register for any of my events at winningthetaxgame.com. That's how you register for the events, winningthetaxgame.com. If you want to do a private one-on-one consult and not a 2-hour workshop with a bunch of people, then just go to rondilambeth.com and schedule a free consultation with me.
Perfect. Winningthetaxgame.com is how you can sign up for those events. And man, I'm so grateful that you came on with us today. So this is a good place to stop. I'm Heath Rost of the Profit with Estate Planning podcast, and I've just interviewed Rondi Lambeth, wealth coach, and we will see you next time. If you enjoyed that episode, you're going to want to stick around for my next episode where I interview Alex Ranja. He's an estate planning attorney who owns 2 law firms out of Illinois, and he specializes in Islamic estate plans. He's built a referral network so strong that he has a never-ending stream of qualified leads that come to him, and he doesn't even have to advertise. So stay tuned for that and learn how to build the strongest referral network possible.